Earnings season is when stocks move the fastest. We're talking 10 to 20, sometimes even 30% overnight. Here's the truth. Most traders actually lose money trading earnings. Today, I'm breaking down how earnings volatility works and the biggest mistake beginners make, the strategies investors use to take advantage of these moves, why earnings create huge moves. Every quarter, companies release earnings reports that reveal revenue, profits, and future guidance. The new information forces the market to reprice stocks instantly. That's why you see massive after-hour moves in names like Tesla, Nvidia, Meta platforms. Many investors don't even realize it's that earnings aren't just about beating estimates. The guidance and expectations matter more even than the numbers itself. Volatility expansion before earnings. As earnings approach, certain uncertainties arise, and so does volatility. Options prices get more expensive as traders expect bigger moves. This creates what's called a volatility expansion. Some traders don't even hold their earnings. Instead, they trade the momentum leading up to the event and benefit from that. Some of the benefits they get is increased option demand, speculation, positioning by institutions. The results, stocks often trend into earnings and before the actual announcement. It's a major risk to play earnings after the announcement. And right after earnings are released, implied volatility collapses, known as the IV crush. That means options premiums shrink dramatically, even if the stock moves into the direction you predicted. Right after earnings are released, implied volatility collapses, known as the IV crush. You can be right on direction and still lose money. This is the most misunderstood aspect of earnings trading. A major reason is why blindly buying options before earnings is so risky. Interesting, the biggest opportunity sometimes happens after earnings. Stocks that beat expectations and raise guidance often enter strong momentum trends driven by institutions buying and analysts upgrades, positive sentiment shifts, breakdowns on huge volumes. This is why some investors wait for confirmation rather than gambling on the announcement itself. Earnings trading comes with serious risks. Overnight gaps with no stop loss protection, unpredictable guidance changes, whipsaw price action, overtrading during earnings season. Even some companies can drop after beating earnings if expectations are too high. Sometimes it's a fake out for the breakout never happens. More disciplined investors choose to focus on trading the pre-earnings run-up, waiting for post-earnings breakouts, managing position size carefully, and avoiding all earning bets altogether. The key isn't predicting earnings perfectly, it's manage risk while positioning for volatility. Earnings create some of the fastest moves in the stock market. It's understanding volatility, expectations, risk management is what separates successful traders from the rest. If you want more breakdowns on this earnings season, we'll go from there. There's so many earnings plays out there. To get into some lately, a lot of these stocks like Nvidia, Tesla, Meta platforms, they've all had either spikes up or spikes down during earnings. Even Palantir had a huge run up and then crashed after. So many other stocks have had the same case. Experienced traders often choose one of four approaches: pre-earnings momentum trade, riding volatility expansion into earnings, then exit, wait and react strategy, let the initial reaction happen and the trade continuation, fade the overreaction. Large emotional gaps can reverse if fundamentals remain strong. Sometimes the best trades isn't the reporting stock, it's the competitors reacting. Examples of this is when a major AI company reports strong results and the AI sector moves with it. EPS versus guidance. Well, it really moves markets. Many investors focus on EPS beats, but markets care more about forward expectations. Strong stocks often react the strongest to raised guidance, revenue acceleration, margin outlook, on AI and macro or demand. Conference calls can reverse the entire initial reaction. This is really why post-earnings momentum trades can be powerful. Option markets estimate a predictable move using IV. This is called the expected move. If the actual move is smaller than expected, volatility collapses and hurts option buyers. If the move exceeds expectations, outsized gains are possible. This explains why some earnings events feel like they're about to explode while others feel muted. Common mistake retailers make: buying weekly options blindly, oversizing positions, crashing after the move, ignoring guidance, over trading every earnings report. Earnings trading is high variation. Even professionals are wrong often. They manage risk. Smart earning traders, they trade small size. They use defined risk setups. They avoid emotional chasing. They focus on quality setups instead of randomness. Remember, earning traders are not required traders. Earning trades are not required trades. Sometimes the best position is no position at all. The biggest opportunity often happens after earnings, when narrative shifts, during catalyst upgrades, downgrades, when institutions reposition, during sector repricing. Earnings season isn't a single event, it's a volatility window. All in all, earnings volatility isn't random. It's driven by expectations, implied volatility mechanics, guidance, narrative shifts, and institutional planning. If understanding these dynamics, you can avoid traps, sometimes position for explosive opportunities. There's many other things that you can get into when you're looking at earnings and how they affect stocks and investing. Just to fall back on the IV crush, it's kind of the main thing. If you're buying stocks or anything like before earnings, you stay there, the odds that you're going to get crushed are really high. This IV crush, it affects option premium. Even winning direction bets can lose money. Straddles shrink rapidly. The stock moves 4%. The option price moves 10. A lot of times it's way more than 4%. Premium drops. Traders lose money despite being correct. The single concept explains why earnings trading feels rigged for many beginners. You have to look at all those factors. Again, earnings can turn into reality and can turn into your worst nightmare. Caught off guard, you could lose massive money, totally wreck your portfolio, even the stock that you're holding. It's so much weighted on what the company's revenue, earnings per share, margins, forward guidance. You could do so much positive to your accounts. Most of the time, holding into earnings when you're trading and everything like that, if you're buying into earnings, it can really crush stocks. They don't move on the numbers alone. They move on expectation versus reality, which means great results can cause sell-offs, bad results can trigger rallies. Guidance can overpower everything. You got to really look at the volatility after earnings and make sure you really want to stick around for earnings, even though especially when you're trading. Expectations can be so extreme. Even when you have strong earnings, it just one way or another may disappoint traders. You got to look at that. You got to, why earnings move stocks so much. Implied volatility explained in a simple way. The IV crush, how pros position around earnings. You got to look at the EPS versus guidance. You got to understand why stocks move, what's the expected move. You got to realize these mistakes could really hurt your portfolio. You got to be able to use risk management and just look at each opportunity if it really exists or doesn't exist. That's earnings in a nutshell, the positive and the negatives of earnings. I think with that, I think it's you can figure it out and make the best of it. You always be cautious around earnings. It's kind of give or take, and doesn't mean you're gonna lose money, doesn't mean you're gonna make money. Earnings are kind of like the two-edged sword.